The Federal Reserve hiking interest rates for the sixth time this year as it tries to beat back the highest inflation in 4 decades.
With today's action, we've raised interest rates by 3.75 percentage points this year. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
The Fed is trying to achieve a soft landing by slowing the economy just enough to lower inflation, but not so much that it triggers a recession. The string of rate hikes making borrowing more expensive, from credit cards to auto loans to home mortgages. The average American is carrying a credit card balance of $6,200. If you're making only the minimum payments, after today's hike, the cost of interest has increased by nearly $1,600 since the start of the year. 2 months ago, a $300,000 home mortgage would have cost you $1,734. Today, it's more than $2,000.
Mortgage rates are up over 7% for a 30-year fixed, and that's hit housing demand very significantly.
The higher cost of borrowing is starting to have an impact on consumer spending. Stocks edged lower in early trading Wednesday as Wall Street prepared for the Fed's announcement.
Stock prices are down about 20% from their peak back at the start of the year, and of course that's having impacts on people's willingness and ability to go out and spend.
Investors hoping for some signal from the central bank that it may possibly slow the pace of its rate hikes in December. On Friday, we'll get the latest jobs report from the Labor Department. The job market remains very resilient despite all these interest rate increases. The number of job openings increased this week to 10.7 million, which means there are nearly 2 jobs available for each person looking for work. Alexis Christoforous, ABC News, New York.